We're back with some breaking economic data.
Yeah, inflation rose by 6% year over year in February. That is down from 6.4% in January. Let's break it down. Investopedia's editor-in-chief, Caleb Silver, is back with us. We're also joined by NBC News business and data reporter Brian Cheung. Good morning to both of you. Brian, let's look at these numbers, break them down. Where are we seeing the biggest increases, and how does this compare with the previous month?
Yeah, Joe, as you mentioned, it seems to be good that the pace of price increases is slowing, although just a bit, 6%, which is a slowdown from the prior month of 6.4%, but also much slower than the 9.1% we saw in the summer of last year. What contributed to the still high inflation, though, remains shelter, the cost of just putting a roof over your head. That cost went up by 0.8% between January and February, and there is some kind of positive indications that we're seeing from more high-frequency data compared to what the government puts out there, that maybe that number will go down soon. But by and large, it seems like prices are still high, although we're seeing some silver linings in the form of food prices actually going up at a slower pace. Eggs and lettuce prices actually were down between January and February. I'm sure welcome news to a lot of
and eggs were the headline of a few months ago.
They were.
There we go.
Yeah, really. Caleb, what's your takeaway from this report?
Yeah, slowly coming down, but not fast enough. But this would have been the biggest story of the month had it not been for the bank failures. But there is a nice decline here. Food prices have been sticky high. Shelter prices have been sticky high. They remain pretty high. But meat, poultry, fish, eggs, all coming down slightly in price. That's a good sign. And energy prices and utilities also coming down. Those were sticky high a few months ago. So some of these key things that we pay for on the daily, they're coming down a little bit. We're just not feeling it yet.
All right, so Caleb mentions the bank failures. So my question to you, Brian, is some wonder if these bank failures could hasten a recession. Where are we at when it comes to talk of a recession or fending off a recession? If we did have one or any sort of slowdown, what would that do to inflation?
Yeah, well, I mean, as a business reporter, I almost forgot that the inflation numbers were coming out this morning because of all the fallout that we saw from Silicon Valley Bank. But, you know, that story, what's happening in the banking industry is very much the looming cloud when it comes to the economic outlook, because inflation was already the biggest story in terms of the uncertainty going forward. For the Federal Reserve, the nation's economic steward, it presents a very challenging situation. They were raising interest rates to try to take steam out of this hot economy, to take inflation down. But high interest rates were also one of the dominoes that led to the collapse of Silicon Valley Bank. Not the primary reason, but one of the factors that led ultimately to that. So maybe they take a step back from the aggressive pace of interest rate hikes to stop the contagion as well. We'll have to see.
Because the Fed is supposed to meet soon, right? Next month. Yeah. How do you expect all of these factors to play into their meeting?
Yeah, next week, in fact, March 21st and 22nd. And the thinking going into this next meeting was the Fed would continue these small raises of 1/4 of a point, but maybe they would do 1/2 a point to really sort of knock the wind out of inflation. But the collapse of these banks, plus a softer number here, may cause the Fed to pause. There are some banks out there saying the Fed may not raise rates at all. In fact, they may start to lower rates. That would be a big shock. I say they still probably go ahead with 1/4 point just to be consistent and really stamp out inflation for good.
So, Brian, if we see a smaller, like 1/4 point or no increase at all, what does that mean for the average consumer?
Yeah, well, I mean, look, at the end of the day, interest rates are still high, and they've, been high for a while. So if you're looking to buy a house, if the Federal Reserve slows the pace of interest rate hikes by maybe not moving at all, they're not cutting interest rates. So that means that mortgage rates, credit card rates, auto loan rates are still going to remain high. So they don't expect any sort of massive change in the story on the housing market, where it's still very expensive to borrow.
All right, Brian and Caleb, breaking it all down for us. Thank you. Appreciate having you both here.
Thanks for watching our YouTube channel. Follow today's top stories and breaking news by downloading the NBC News app.